When the world looks at the empire of Elon Musk today, the imagery is dominated by the sleek silhouettes of reusable rockets returning from orbit and the ubiquitous presence of electric vehicles, fundamentally altering the global automotive landscape. The narrative often jumps straight to these monumental achievements, painting a picture of a visionary who seemingly materialized out of the ether to conquer aerospace and sustainable energy. Yet, to truly understand the architecture of this unprecedented wealth and influence, we must look backward, far beyond the launch pads and gigafactories. We must focus on uncovering the gritty, unglamorous financial groundwork that made these later triumphs possible. True financial freedom and empire building do not begin with billion-dollar industries. They begin with calculated, high-stakes decisions made in the trenches of early entrepreneurship. By examining the rarely discussed mechanics of his initial business endeavors, we can extract a masterclass in strategic capital allocation, relentless reinvestment, and the deliberate construction of wealth. This is the blueprint of how the foundational capital for a multi-industry empire was forged through relentless effort, strategic exits, and an ironclad tolerance for risk. The journey begins in the mid-1990s, a period characterized by the nascent explosion of the commercial internet. At this time, Elon Musk was not a billionaire titan, but a young immigrant with a profound understanding of the digital frontier and a willingness to endure extreme personal deprivation to build something of value. In 1995, he and his brother Kimball founded Global Link Information Network, a company that would soon be rebranded as Zip2. The premise was deceptively simple but highly ambitious for its era, an online city guide that combined business directories with digital maps. In today's hyper-connected world, this sounds like a basic utility, but in 1995 it was a revolutionary concept. However, the reality of building this company was a stark contrast to the polished image of Silicon Valley success. The early days of Zip2 were defined by severe financial constraints. The brothers lived and slept in a small, rented office in Palo Alto, showering at the local YMCA and surviving on a meager diet. Musk coded the platform at night and pitched it to local businesses during the day. This period highlights a crucial reality of early entrepreneurship. The initial phase is rarely about glamour. It is about survival, relentless execution, and the willingness to sacrifice personal comfort for the sake of the enterprise. The strategic brilliance of Zip2, however, was not just in its software, but in its eventual business pivot. Initially, the company struggled to convince individual small businesses to pay for online listings. Recognizing the friction in consumer-facing sales, Musk engineered a masterful shift toward a business-to-business model. Instead of selling directly to local shops, Zip2 began licensing its software to major newspaper publishers, including the New York Times and the Chicago Tribune. The newspaper industry was terrified of the impending digital revolution and desperately needed a way to bring their local classifieds and directories online. Zip2 positioned itself as the essential infrastructure provider for these legacy media giants. This pivot transformed the company from a struggling consumer directory into a highly scalable enterprise software business. It was a masterstroke of market positioning, proving that foundational capital is often secured not by chasing the most obvious customer, but by identifying and solving the existential fears of deep-pocketed institutional clients. As Zip2 gained traction, the need for expansion capital became undeniable. In 1996, the company secured a $3 million investment from Moore Davidow Ventures. This influx of capital was transformative, allowing Zip2 to hire professional engineers and scale its operations nationwide. However, this financial milestone came with a steep, often painful cost that many early-stage founders must face: the dilution of equity and the loss of operational control. The venture capitalists, seeking seasoned leadership to guide their investment, brought in an external executive to replace Musk as chief executive officer. Musk was relegated to the role of chief technology officer. For a highly driven founder, this demotion was deeply frustrating, yet it was a necessary concession. It is a vital lesson in the architecture of wealth. Holding a smaller percentage of a rapidly growing, highly capitalized entity is vastly more lucrative than maintaining absolute control over a starved and stagnant one. Musk accepted the dilution and the loss of the CEO title, understanding that the venture capital was the fuel required to push the company toward a lucrative exit. That exit materialized in February of 1999 at the height of the dot-com boom. Compaq Computer Corporation, seeking to bolster its Alta Vista search engine, acquired Zip2 for $307 million in cash. From this transaction, a 27-year-old Elon Musk walked away with $22 million. This moment represents the first major inflection point in his financial journey. For the vast majority of people, a $22 million windfall is the finish line. It is the moment to diversify, invest in safe, yield-bearing assets, and retire to a life of leisure. But the mindset required to build an empire operates on a fundamentally different frequency. Instead of retreating to safety, Musk viewed this initial fortune not as a retirement fund, but as the foundational capital necessary to attack a much larger, far more entrenched industry. Within weeks of the Zip2 sale, Musk took the extraordinary step of rolling roughly $12 million of his own cash, more than half of his net worth at the time, directly into a new, highly speculative venture. This aggressive reinvestment strategy is the hallmark of his approach to wealth generation. He understood that to shape the future and generate exponential returns, one must continually push their chips back into the center of the table. The target for this massive capital deployment was the archaic, slow-moving financial services industry. Musk founded XCOM, envisioning a revolutionary online financial supermarket that would offer banking, mutual funds, and insurance under one digital roof. The ambition of XCOM was staggering. In 1999, the idea of trusting a web startup with your primary bank account was virtually unheard of. The regulatory hurdles, the security requirements, and the sheer technological complexity of building a digital bank from scratch were immense. Yet Musk utilized his foundational capital to hire top-tier talent and aggressively acquire customers. One of the most critical innovations to emerge from XCOM was the ability to send money seamlessly via email. This feature bypassed the cumbersome traditional banking infrastructure and offered a frictionless method for peer-to-peer transactions. It was a paradigm shift in how money moved, and it quickly became the killer application of the platform. However, XCOM was not the only company to recognize the potential of email-based payments. Across town, a startup called Confinity, led by Peter Thiel and Max Levchin, had developed a similar product called PayPal. What followed was a brutal, cash-burning war of attrition. Both companies were spending millions of dollars in venture capital to acquire the same users, offering cash bonuses to anyone who signed up for their respective platforms. Musk, demonstrating a sharp strategic pragmatism, recognized that this fierce competition was a race to the bottom that would ultimately bankrupt both entities. In a decisive move to preserve capital and dominate the market, XCOM and Confinity agreed to a merger in March of 2000. The newly merged company, which would eventually adopt the PayPal name entirely, was a volatile combination of brilliant, highly opinionated founders. The internal culture was notoriously intense, marked by severe technological disagreements and power struggles. The most significant of these conflicts centered on the underlying software architecture of the platform, pitting Musk's preference for Microsoft technologies against the Confinity team's reliance on Unix. The tension culminated in a dramatic boardroom coup. While Musk was en route to Australia for a much-delayed honeymoon, the board of directors, influenced by internal dissent, orchestrated his removal as chief executive officer, replacing him with Peter Thiel. Being ousted from the company he had poured his fortune and energy into was undeniably a harsh blow. Yet it is precisely in the aftermath of this coup that we see another masterclass in financial discipline and strategic patience. A lesser entrepreneur might have allowed ego to dictate their financial decisions, hastily selling off their shares in a fit of resentment. Musk, however, recognized the immense underlying value of what they had built. He remained on the board, retained his position as the company's largest single shareholder, and allowed the new leadership team to navigate the company through the treacherous waters of the dot-com crash. This ability to separate personal ego from financial reality is a critical component of long-term wealth building. By holding his equity, he allowed his foundational capital to continue compounding in value, even when he was no longer at the helm. Under Thiel's leadership, PayPal refined its focus, abandoning the broader financial supermarket concept of XCOM to concentrate entirely on dominating the digital payment space, particularly as the primary transaction engine for the rapidly growing online auction site eBay. The strategy was highly effective. PayPal grew exponentially, becoming an indispensable tool for millions of online merchants and buyers. In early 2002, despite the broader tech market being in a severe depression, PayPal successfully executed an initial public offering. Shortly thereafter, recognizing the absolute necessity of the payment platform to its own business model, eBay moved to acquire PayPal in a massive all-stock transaction valued at $1.5 billion. When the acquisition closed in October of 2002, Elon Musk's strategic patience and high-risk reinvestment yielded an astronomical return. As the largest shareholder, his payout from the sale was approximately $180 million after taxes. This staggering sum represents the true, solidified foundational capital that would serve as the bedrock for everything that followed. The journey from the cramped, showerless office of Zip2 to the billion-dollar exit of PayPal was a crucible that forged not just immense wealth, but a hardened, battle-tested entrepreneurial philosophy. What Musk did next with this $180 million is perhaps the most defining chapter in his financial narrative, and it completely defies conventional wealth management wisdom. Instead of preserving this immense fortune through diversified, low-risk investments, he chose to engage in an unprecedented level of capital concentration. He looked at the most stagnant, capital-intensive, and difficult industries on the planet, aerospace and automotive manufacturing, and decided to fund their disruption entirely out of his own pocket. He poured roughly $100 million into the founding of Space Exploration Technologies, or SpaceX, aiming to revolutionize space travel and make humanity multiplanetary. He directed another $70 million into a struggling electric car startup called Tesla Motors, determined to accelerate the world's transition to sustainable energy. He also allocated $10 million to help found Solar City. By 2008, this aggressive strategy of complete reinvestment brought him to the absolute brink of personal bankruptcy. Both SpaceX and Tesla were hemorrhaging money, facing technical failures and the devastating impact of the global financial crisis. Musk was living off personal loans from friends, having bet every single dollar of his PayPal fortune on these highly improbable ventures. Yet, because he had built such a massive, unencumbered pool of foundational capital through his early software ventures, he had the singular ability to keep these companies alive just long enough to achieve critical milestones. He funded the operations just long enough to see a successful rocket launch for SpaceX and to secure crucial government loans and private investment for Tesla. The architecture of Elon Musk's empire is not a product of overnight success or inherited wealth. It is the result of a deliberate, highly strategic sequence of entrepreneurial ventures. It began with the gritty, unglamorous work of building Zip2, making the difficult pivot to enterprise software, and accepting the dilution necessary to secure a lucrative exit. It continued with the fearless decision to roll those early millions into the high-stakes, highly regulated arena of digital finance with XCOM. It required the strategic pragmatism to merge with a bitter rival, and the disciplined patience to hold equity through a boardroom coup and a market crash. Ultimately, the story of how his early ventures built his foundational capital is a testament to the power of asymmetric risk. It proves that true, world-altering wealth is rarely achieved by playing it safe. It is built by those who are willing to endure the brutal realities of early entrepreneurship, secure their capital through strategic exits, and possess the relentless, unyielding courage to push all their chips back to the center of the table, time and time again, to shape the future of human progress.